Hold on tight. After a rollercoaster week on Wall Street, with some major dips followed by a powerful surge, the question on everyone's mind is, can the market keep this momentum going? Stock futures are hinting at a relatively flat start, but don't let that fool you. The underlying dynamics are anything but calm. Let's break it down. Monday night saw stock futures trading near the flat line after a session of significant recovery. Futures contracts for the Dow Jones Industrial Average showed a slight upward tick around 19 points. Meanwhile, S&P 500 and Nasdaq 100 futures were nearly unchanged. But here's the exciting part. The previous trading day witnessed a substantial rebound. Both the S&P 500 and the Dow Jones Industrial Average jumped by over 1%, with the S&P 500 recording its best single-day performance since May 27th. The S&P 500 managed to recover more than half of the losses it sustained on Friday. The Dow also had a stellar day, marking its best performance since September 11th, snapping a 5-day losing streak and recouping approximately two-thirds of Friday's decline. Think of it like a boxer getting knocked down, then bouncing right back up with a vengeance. So what fueled this dramatic turnaround? A key factor seems to be a message posted on Truth Social by former President Donald Trump, which appeared to ease investor anxieties regarding escalating trade tensions between the United States and China. Trump's post, stating "Don't worry about China, it will all be fine," seemed to inject a dose of optimism into the market. This perceived de-escalation of trade war fears particularly benefited technology stocks. Companies like Oracle, AMD, and Nvidia experienced broad gains, leading the overall market rally. The tech-heavy Nasdaq Composite Index surged by more than 2%. And this is the part most people miss. Trade policy has been a major influence on U.S. financial markets throughout the year, and the past week saw a considerable increase in tensions between the U.S. and China. As Ulrika Hoffman-Burchard, global head of equities at UBS Global Wealth Management, pointed out, with both sides taking firm stances, we can anticipate more market volatility as the month progresses. However, history suggests that Trump-Xi negotiations often involve periods of heightened tension, followed by temporary agreements. The possibility of a deal involving rare earth minerals versus shipping fees could ultimately lead to a resolution. Think of it like a chess game, with each side making strategic moves and countermoves. Now, investors are eagerly awaiting Tuesday, when major financial institutions like JPMorgan Chase and Goldman Sachs are scheduled to release their third-quarter earnings reports. These reports will provide valuable insights into the health of the economy and the performance of the financial sector. But here's where it gets controversial. Some analysts believe that relying on social media posts for market signals is a risky game. Is it prudent to base investment decisions on the pronouncements of political figures, especially when their statements may not always be consistent or fully informed? Others argue that in today's fast-paced information environment, social media has become a legitimate channel for influencing market sentiment. What do you think? Should investors pay close attention to social media commentary from influential figures, or should they stick to more traditional sources of financial information? Do you believe that the recent market rally is sustainable, or is it just a temporary blip before more volatility hits? Share your thoughts in the comments below.